Learn the art of investing on Moneywise.
Welcome to the Moneywise Podcast. Today, we're about to understand what large cap investing is all about. And I'm quite certain you have several questions, and we have the expert to clarify all of your doubts. And that expert today is Sumit Agrawal, who is Senior Vice President, Fund Management Equities at IDFC Asset Management Company. Well, thank you so much, Sumit, and welcome to the Moneywise Podcast. And how are you doing today?
Thanks, Hetal, and good to be here. Thanks for having me.
Well, it's our honor and pleasure entirely because for our benefit of our listeners, Sumit has over a decade of experience in the area of finance. He's also been associated with the organization since 2016. He's very passionate about wealth creation, which is a very nice thing to my ears and will be yours as well as soon as he shared his wisdom with us. And he also holds an MBA in finance. So just the man we need to go to understand what large cap means. And that is really my first question for you, Sumit. So do explain this area to all of our listeners, specifically the ones who are new to the world of wealth creation.
Thanks. I think that's a good starting point. So see, basically, I think in the last few years, investing as a whole has taken an all new meaning with the new developments of social media and the reach, the affordability of mobile phones. I think investing, especially through equities, has reached the nook and corner of the country. In that context, I think understanding how different is large cap as a segment for investing, I mean, it's a very good question to start with. What actually is meant by large cap? Essentially, you are investing in a segment of companies which have proven themselves in the past so many years, So if you could recollect, let's say, when you and I were, let's say, kids, or let's say 25, 30 years ago, you would still have heard of brands like, let's say a Lifebuoy or Complan, or, let's say a Hero Honda, or, many of such names. Right. Now, if you recollect today, these names are, still live with each one of us. These are the companies which are still present and coming up, and have a range of products which they are still offering. So essentially what large cap segment means is that these are the segment of companies which have been there in the business for a very, very long time, maybe like 20, 30, 50 years. Therefore, they have established track record. Generally, the longer you have been in the business, the more you learn from experience. So therefore, they have a stable businesses with established track record, generally run by a very good management teams. This is one area which generally is considered to be the first stepping stone of investments. Normally, we say that whenever an investor enters into a stock market or, in the world of investing or wealth creation, his first allocation should be towards large cap investing. If you look at the market regulator, which in this context is SEBI, they have made it easier for the general public in the last 2-3 years. So purely from a definition perspective, I think the top 100 companies in the country, which is defined by some mathematical formula of, let's say, top 100 average market cap for the 6-month period, I think you can ignore it. For simplicity purpose, it would mean that the top 100 companies in the country can be termed as a large cap segment and generally considered to be, the starting point.
So, Sumit, if you could explain to our listeners how long an investor should invest in large caps in order to create wealth, and also how does it compare to mid and small caps?
Yeah, actually, that's a very, very interesting question. Taking this forward, let's say companies which are beyond the top 100 are generally termed as the mid and the small cap segment of the market. So, by that logic, these would be companies who are relatively, let's say, younger, or they might have not reached that stage of, the top 100 kind of proven track record. But generally, the smaller you are, the rate of growth is high. So generally, growth-oriented investors do get excited by investment opportunities in the mid and small cap segment. So vis-a-vis, let's say some of the times there might be phases wherein the mid and small cap segment actually delivers better than the large cap segment. But generally, when you are in a down cycle, or let's say where the overall market segment is slightly weak due to, let's say, weak macros or some geopolitical tensions or some liquidity crisis, most of the money tends to stick with the top 100 companies, because that is where generally the risks are lower. So if somebody wants to stay invested, he would try and avoid the risk in the mid and small cap segment, and let's say he would restrict his allocation to the large cap segment. So therefore, if you see the drawdowns, something which we call as that, let's say you invested 100 rupees, and let's say in the market down cycle, to what extent that 100 rupees came down? Did it become 95? Did it become 90? So now this number will vary based on the market cap segment. Historically, we have seen based on the data that is there and which is actual data and not any forward-looking data. Generally, large caps have relatively lower drawdown. And they kind of protect your wealth whenever things are slightly shaky, let's say, in the overall scenario. So therefore, these are some of the benefits of having large cap in your portfolio. Now, your first question on, how long should an investor stay invested in large cap in order to create wealth? I would say generally equities as an asset class has given solid returns when you have stayed invested in it for a longer period of time. So if you see data of 10 years, 15 years, generally we have seen that an equity investor has comfortably beaten inflation, and at the same time he has beaten some of the returns of some of the other asset classes also. Although, these days, longer time frame, generally people want to make money very quickly, but my advice is that at least stay there for 5 to 10 years. And if you have some of your goals, which obviously under the advice of your financial advisor, if you have some goal-based investing, try and stick to that and stay there for a longer period of time, because that will give you a time to ride the volatility, and at the same time at the end of the journey you would be having relatively better returns as well, and as a result you will be creating some wealth as well. Even in the current context, if you see, where generally we are seeing that there is some kind of a slowdown in the market due to raw material prices, or there is some geopolitical tensions, you can't stay away from equities, because that would be a suicidal mistake to completely become zero, because the near term looks bad. But there is a saying that if you keep investing in red when the market is red, I think you will enjoy when the market turns green, so because that is what the advantage of long-term investing and systematic investment plans is all about. So do not get perturbed by it. I think stick to good quality long-term, not large cap kind of space, and you should ride the volatility well.
You're listening to Moneywise, successful investment ideas that create wealth. Did you know?
The calendar year 2020 saw an all-time high fundraising through the public equity markets at Rs 1,77,468 crore, despite being overshadowed by the pandemic. This was 116% higher than that of calendar year 2019 and included IPO, QIP and OFS proceeds.
Personal Finance Simplified, only on Moneywise.
So I was about to ask you that, because we've seen a downturn in industrial output since the pandemic really began. And there's also the speculation that India might even see economic growth slow down. So would you summarize that as investors should be considering large caps even at a time like this?
Yeah, so historically, businesses have always moved in cycles, and so have been the stock market. So, any cycle, if you see, let's say there is a bull market, there is a bear market, there is a period of recovery, and economics is about that, it's about cycles. So generally, if you stay over a cycle, I think you should do well when you stay with your investment journey. So therefore, even if, let's say, the current scenario looks slightly weak because of the industrial slowdown or the high crude oil prices, which are, running above $100, or some of the other tensions, or higher interest rates for that matter. But generally, this is a good time for staying put to your investment plans, So because if the prices are lower, you will get advantage of investing regularly at lower prices. And let's say whenever the recovery occurs, all this thing will actually give you good results. So I would say, although near term, it might not be behaviorally very, very comfortable to invest, but I think from a financial point of view, I think it makes great sense to stick to your investment plan during a market downturn. And if possible, and if it's permitted by your personal finances, you should even increase some allocation when the markets are weak.
Now, we're seeing a lot of interest in the area of passive investing, right? So I thought it would be important for our investors to understand, A, what is passive and what is active, and B, what does the investor need to know with respect to the active management of large caps? Sumit.
Yeah, so actually this is a very pertinent question in current times, especially in the last 5 years. I think passive investing as a space has grown materially. And
Right.
it's generally very, very exciting to new age investors who are generally app savvy or tech savvy, or we call it a DIY investors, do it yourself investors.
Right.
Now, just for simplicity purpose, passive investing would mean that you are investing in a low cost strategy, and you are investing in a particular index, let's say, which is defined by market, and it can be your choice. It can be a large cap index, it can be a mid cap index, it can be a small cap index. But generally, the fund manager there or the investment team there would not have material say in the way stocks are being allocated or picked. They will just follow the index, and there will be some minimal cost because of the operational expenses, and the investor will relatively get the return, which is market linked return. This looks very, very exciting when it comes to the cost side, because these are generally low cost strategies. However, on the active side, there is a experienced fund management team, there is an experienced investment research team which actually keeps on identifying ideas, and they can go overweight or underweight the sectors or the securities within the index with an end objective of actually outperforming the index return. The good part is that there will be years when active strategies will do well and they will outperform the passive strategies. We have also seen some examples in the past where in a few years the passive strategies have outperformed the active strategy. So there's no good and bad about it. It's a choice. It's a part of the allocation that investors can have in their portfolio. But generally, over a long term, we have seen that there are benefits of stock picking, and this is not only in India, this is also in some of the developed markets in the world, wherein active stock picking has actually contributed into alpha. So I'm not saying 100% of the funds will outperform the index, but there will still be some good number of funds which will be outperforming the index. So both the places have an ideal space in one's asset allocation, and one should actually stick to that.
Sumit, here, this is where we move a little bit more, 30,000 feet and check with you on some of those time-tested pearls of wisdom that you believe listeners should bear in mind with respect to large caps from your experience.
So basically, at the end of the day, when we think it all comes down to investor behavior, because, we might see that while a fact sheet returns would look very good, when you look at the return of the index or the funds on a YOY basis or a particular time period, the same returns generally do not reflect in your actual account statement. Now, the reason is that your entry and exit into the market or into the funds is generally being driven by your emotional state of mind, or how do you think that way. So if I ask you today, let's say if the markets are down by 1,000 points, you would not be in the best of the mood to actually invest. You would say, "Arey, market is down. Let's wait for some more time. Why should I go ahead and rush right now?" But the point is, markets are unpredictable. So, if you keep your emotions aside and do not get bogged down by near-term noise or, some of the macro headwinds, which actually prevents you from putting your money to work. So the key is to avoid such instances, and that does not require a lot of IQ. It requires a lot of emotional question, I would say. The way you deal with your finances, the way you feel when your portfolios are actually down. The key point, how we deal with all these things is, if you have your long-term goals in mind and you follow a particular asset allocation pattern and you stick to your plan, so despite of the medium-term volatility, I think over a long period of time, you should be able to do good. So short answer to your most important question. First is, have a long-term orientation in mind. Second, do not fall prey to the emotional responses when the markets temporarily, turn bad or weak, and stick to your plan. Maybe there are ample of them, but I think these are the two most important ones which I think listeners should be aware of.
Probably very, very tough ones to implement, the longer view and keeping the emotions in check. But certainly it's good to be reminded that these are fundamentals when you are embarking on a wealth creation journey, especially with large caps in mind. And thank you so much, Sumit. You've really helped us understand, especially for our newbie listeners, on what this area is all about and why it's critical to their, or like you put it, right? It's one of the stepping stones to their investment journeys. Thank you for being here with us on the Moneywise Podcast.
Thank you so much. All the best.
You're listening to Moneywise, brought to you by IDFC Mutual Funds. Check out the rest of our series for more investment advice. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.